Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith. Let's get to the three things that you need to know today. First up, the S&P 500 trading within points of its record high and getting fresh momentum today as the U.S. and China confirm they have reached a trade deal. And Commerce Secretary Howard Lutnick says the U.S. has imminent plans to reach agreements with 10 major trading partners. Meanwhile, traders watching the Fed's preferred inflation gauge this morning, showing inflation rose slightly more than expected last month, but U.S. consumer spending declined in May by the most since the start of the year, indicating elevated uncertainty around the Trump administration's economic policies. And Nike shares jumping today as the company's turnaround effort gathers steam. Investors are hoping CEO Elliott Hill's strategic moves are paying off after the stock had lost a third of its value over the past 12 months. While the company did withhold guidance for the full fiscal year due to tariff uncertainty, it did report better than expected fiscal fourth quarter earnings and revenue. Let's get a check-in on stock futures here this morning. We're inside of 30 minutes until the start of trading here and taking a look at the Dow, the S&P 500, and the NASDAQ here. A key level to watch, of course, here for the S&P 500 because at this level, we would potentially be looking, if we hold on to these gains right now, of opening at a new record high for the S&P 500. We're going to keep close tabs on that. We're also watching the Dow futures. That's up by about 0.3%. You're also seeing the NASDAQ futures pointing higher by about 0.25% right now. Let's turn to our top stories of the day. The S&P 500 nearing record highs and gaining ground as the U.S. and China confirm their trade deal. Plus, we've got Nike surging as its turnaround plans gain traction. And the Fed's preferred inflation gauge, PCE, crossing the wire. So what does it mean for rate cuts this year? All right, those are the questions, and now for the answers. Joining me now, we've got Ali Canal live from the NASDAQ, Jennifer Schonberger, and Julie Hyman. Ali, let's start with you. We're on record high watch here.
Record high watch. We have markets that could test those all-time highs. That benchmark S&P 500 closed just shy of that record yesterday. We were only off 3 points. Like you were just saying, Brad, if these gains hold throughout the trading day, we will see a new record for the S&P, which would mean that we would have rebounded. We already have rebounded around 20% since those April lows. So it's just been an incredible run up for the indexes. Now, another point that I want to make is that there's a few things that are driving these stocks higher. Number one is the trade negotiations, particularly with China. China was the number one country that investors have been looking for. And President Trump, he did confirm that a trade deal has been signed. Beijing making a notable concession here, which is a pledge to approve U.S. export applications for rare earths. Now, that's been a long-standing pain point in these negotiations. In return, China said the U.S. will roll back some restrictions, that we don't have those specifics just yet. And then separately, Commerce Secretary Howard Lutnick, he said that there are trade deals with 10 other countries that the U.S. will announce in the coming days and weeks. So this is unfolding as budget talks continue to ramp up in Congress. So a lot of policy momentum here that the markets seem to be looking towards. And then you had this PCE inflation report out earlier this morning that showed a bit more of a stagflationary picture. And obviously, Fed rate cuts are something that investors are watching closely too. So Julie, I wanted to toss it on over to you because there seems to be a lot of optimism in this market that we could keep chugging higher here. But of course, there are also a lot of risks as well.
Yeah, and there's a lot of still debate on the street, right, about where stocks are going to go from here. A couple of different notes from strategists throwing that into relief this morning. So UBS Asset Management, on the one hand, Global Wealth Management, I should say, raising its year-end target for the S&P 500. It's raising it to 6,200 from 6,000. So let's parse that a little bit, right? Because 6,200 is, we could open above those levels today. So they're sort of directionally, incrementally more optimistic. Earnings is one of the reasons why they think things are going to get better for the growth and inflation outlook in the second half of the year once we kind of lap maybe the peak tariff effect. So that's on the one hand. On the other hand, we've got Bank of America's Michael Hartnett saying he's concerned about a bubble, a speculative bubble in the second half of the year. And he's in the camp of folks that are watching valuations, which have been going up. We have seen an enormous amount of equity inflows, he says, into U.S. stocks this year, the third highest on record. And I've seen other commentary over the past few days talking about the so-called FOMO trade coming back, the fear of missing out trade coming back, with a lot of performance chasing of highly speculative stocks, for example. So we are seeing valuations creep up. There are a lot of strategists right now who say that earnings growth is going to support that and propel further gains even above 6,200. But of course, that remains to be seen. And Jennifer, of course, the backdrop is what's going on with the economy.
Yeah, hey, Julie. And that report we got out this morning on the Fed's preferred inflation gauge, the Personal Consumption Expenditures Index, which has both personal income and inflation, has a little bit for both the hawks and the doves on the Fed. Inflation coming in a bit higher than expected, so a point for those hawks. And personal income and spending coming in a bit lower, so a point for those doves. But I think there may be some one-off issues going on here. We saw a lot of front loading with tariffs earlier this year, and we're seeing that reverse in this report. Also, it was pointed out that the decrease in personal income primarily affected government social benefits to people and farm proprietors' income. So I'm not really worried that the Fed is going to be too worried about the personal income side of the economy based specifically on this report. This seems like sort of one-offs. So this doesn't really change the calculus from what I can tell for the Fed. And earlier this week, we heard from Fed Chair Jay Powell, who testified before Congress, and he says he doesn't really think that we've really seen the impact of tariffs on inflation yet. He's really looking to those summer months, June, July, and August, to see what the impact is going to be. And if those reports come in mild, then he seemed to imply a rate cut could be in play for September. But this very much points to a continuation of the wait and see camp. One thing that is going to be very interesting to me to watch is that we know that there are two very clear doves on the Fed committee, both Fed Governor Waller and Mickey Bowman. And Bowman said earlier this week on Monday in a speech that if inflation comes in mild ahead of the July meeting, she would support a rate cut. Well, this morning was a bit of a gray area. So I'm really going to be looking to see whether those two governors end up dissenting at the July meeting. But it's very clear we have a divided Fed, and this report certainly isn't going to settle that debate.
How, and within that, Jennifer, just to follow up on that, how could this divided Fed be further impacted in their at least thought process, especially coming off of tariff policy that they needed to see how it played through, and then waiting for deals, waiting for clarity, which we're just hearing this morning, of course, on the U.S. and China deal, and 10 more, according to Howard Lutnick, that are set to come within days here. How that could also impact what they're waiting to show through in the data going into those meetings where they're anticipated to start to kick off some of the 50 basis points of cuts that markets are anticipating by the end of the year.
Yeah, Brad, I mean, Chair Powell said very clearly this week that if uncertainty were to lift, then that would certainly help the case for rate cuts. But it really comes down to what is the effective tariff rate? And while we did see a deal announced on China on those rare earth minerals, it's unclear whether we have any settling on the tariff rate for China and for any of these other countries. So I think there's still a lot of information that the Fed needs to receive. And again, Chair Powell had said it's going to take time for a lot of this to work through the economy. The three major things that are going to be important for whether tariffs have an impact on inflation are, one, the effective tariff rate, two, inflation expectations, and three, how long it takes for those tariffs to be passed through to prices. Is it going to be quick, which could be maybe like a one-time reset in price, or is it going to be slower, which would be a case for more persistent inflation? And Allie, are you watching those Fed futures? I haven't had a chance to check. What are markets pricing in over there?
Yeah, Fed futures have been bouncing around a bit. Immediately following this report, we saw odds of a July cut move slightly higher, about 23%. Yesterday, we were at 21%. It seems like now we might be back to that roughly 21% range. So markets obviously trying to digest this report. And as you were just saying, Jen, there's something for, the hawks and the doves here when we look at what possibly could come out of rate cuts. I think a lot is going to ride on the labor market and whatever we see next week with the BLS jobs report. If that comes in strong, as we've seen over the past few months, I think it just adds more conviction for the Fed to remain on hold. However, there have been cracks within the labor market. We have seen continuing claims edge higher. So if we see any surprise uptick in the unemployment rate, I think then the argument maybe shifts to, can we or should we cut in July to stem some of this stagflation bleeding? So, like you were alluding to, we have a very divided Fed. I think there's something that you can look at more closely when it comes to the economy, whether it be inflation, the labor market, or the growth story here. But it seems like for now, markets are continuing to price in that September cut. The July cut just seems to be a bit off the table for now, but we know how quickly things can change.
Okay, and lastly here, Julie, I'm actually looking over to see which sneakers you're wearing today. They are not Nikes, but Nike shares are jumping here pre-market. You got some bullish calls out here on the street from Jefferies.
Yeah.
You just buy it this morning.
Yeah, a number just buy it. That's cute. Yeah, we don't have our sneaker cam ready, unfortunately, here this morning, but I am not wearing Nike's spoiler. I also like Simeon Siegel's comment, less bad is good enough. This was not a spectacular quarter by any measure. Sales still fell by 12%, but a lot of the different numbers, including that top line revenue number, beat estimates. And so indeed, for the street, that's good enough, especially considering that the stock is down 17% this year. And Elliott Hill, the CEO, of course, talking about his turnaround plan starting to take hold and make some progress. He says, from here, we expect our business results to improve. It's time to turn the page. He said that on the conference call here. The other thing that analysts were looking for was progress on the inventory front. As you well know, Brad, there has been a big inventory buildup in various channels for Nike. It's also been trying to repair its relationships with its retail partners. CFO Matt Friend said that inventory cleanup is proceeding and that they have a healthy and clean position in terms of where they're going into the second half of the year. I know that analysts like Anisha Sherman over at Bernstein were looking for that commentary in particular on inventory. Just want to mention the effect of tariffs as well, because the company says it's going to increase tariffs, that is, will increase costs by about $1 billion. Because of their China sourcing. So it's possible that at least part of the upside we're seeing this morning, Brad, is because of those headlines on a China deal. Because if that is going to be a big stress on Nike, if there's relief on the horizon, that can be good news for investors as well.
Yeah, absolutely. And thinking about what some of the calls are this morning off of the earnings, coming back to this Jefferies note, they're saying that EMEA, which is Europe, Middle East, Africa, leading the global recovery for Nike here, talking about the momentum being strongest there, where they made strides in cleaning up the marketplace, repositioning digital. But you think about that region, and who's typically been able to grow and really maintain some of that market share? It's from brands like Adidas. It's been brands like Puma that are core and call that region home. So how are we seeing some of the other major retailers move on these Nike results, knowing that, okay, if Nike is signaling that the worst may be behind them, what could this mean for us in the mindset of the consumer as well?
It looks like good things. Briefly, right? We're seeing that those other shares are also rising this morning. The Pumas, the Adidases of the world, but also we're watching some of the U.S.-based footwear retailers. Actually, that's Adidas. U.S. shares. So if you look at how they're trading in Europe, we have been seeing some gains for some of those stocks. And then if we look through the feed through here in the U.S., we've seen a little bit of optimism priced into some of the shares too. When we're talking regions, by the way, I do want to mention, if I didn't already, that Greater China was the only geographical area that did not beat estimates. So continuing the trend of some U.S. companies that are having a little bit more friction in that market.
Yeah, and to sports, one to reckon with and growing quickly over in China as well. Ali, Jennifer, Julie, thank you. Thanks so much for taking the time this morning. Now time for some of today's trending tickers. We are watching NVIDIA, Tesla, and Rocket Lab. First up, NVIDIA's hot streak set to continue after the chipmaker's record-breaking close Thursday. The artificial intelligence company, which made history 2 years ago when it became the first company to reach a market cap of $3 trillion and quickly got to $1 trillion, is quickly approaching another first, the first company to reach a $4 trillion market cap. NVIDIA's 64% rally from its April low has put it back into the top spot as the world's most valuable company. Chip makers as a whole are moving higher today after Chinese and American officials announced a U.S.-China trade deal. Next up, reports saying Tesla CEO Elon Musk fired Vice President of Manufacturing and Operations Omid Afshar amid a decline in sales of its electric vehicles. Afshar set to be the second upper-level employee departing from Tesla following the resignation of the former head of the Optimus humanoid robotics program. Tesla's share price is down 19% this year. Several headwinds facing the stock this year include Musk's feud with President Trump and expectations that EV tax credits will be removed in Trump's Big Beautiful Bill. Finally, Rocket Lab shares hit a record high during trade Thursday after announcing 2 launch deals with the European Space Agency set for later this year. Rocket Lab will send 2 prototype satellites into space, testing low Earth positioning, navigation, and timing. The space agency says that they chose the spacecraft manufacturer over its quick turnaround time and small satellite development skills to hit a quick deadline. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up on Morning Brief, we count you down to the opening bell on Wall Street. Stocks poised to open at a record high for the S&P 500. All that and much more coming up on Morning Brief. Stock futures rising on the cusp of fresh record highs as optimism around trade talks offsets a hotter than expected May PCE print. This a sign potentially that trade talks could continue to dominate market action as we leave the volatile first half and head into the second half of the year. Let's bring in Keith Lerner, Truist Co-Chief Investment Officer and Chief Market Strategist. So, if we round up what the market has had to consider in the first half of the year and then try to understand what is going to be the prioritization in 2H, what are the expectations from how you're looking through it at Truist?
Yeah, well, it's a good question. I mean, if you gave someone all the information December 31st and said, where's the market going to be in June? You probably wouldn't think the market was up just a few percent, but I mean, we've had huge volatility.
Or back at record highs.
Back at record highs as well, right? So listen, I think first of all, we're coming close to breaking out to new highs. That's a positive from a technical basis. And I do think there's this kind of transition or this reverse order from the Trump administration from the prior one where he kind of, put the tariffs up front, and now the market's starting to focus on some of the more positive aspects, at least growth aspects, being the tax bill likely gets through. We might see some volatility around that, but ultimately we think it gets through. Deregulation coming as well. And at some point in the second half, we expect the Fed to cut rates. So I think all that means the market does move higher, but there'll certainly be some gut checks along the way in our view. And the one constraint from here, even though the technical picture is very strong, is that the valuations of the market are close now back to 22 multiple, which is the high end of the range that we've seen the last few years. So that doesn't mean it can't move on. It may just say, it may constrain how far you go up to the upside.
I'm glad you brought up valuations. We had Jessica Inskip, who was one of my guest and contributor hosts last week, and she was making the point, and it made sense. People argue stocks look expensive compared to long-term averages, but we often ignore perhaps how different the market is structurally. How different is the market structurally, and how should we be changing our thinking around the entire valuation analysis right now?
Yeah, I completely agree with that. When people look, they have this historical lens saying, hey, the average PE is 16. Well, here's a stat that's interesting. Back in 1990, the tech sector was only about 5% of the S&P. Today, it's more than 30%. And actually, if you include communication services and some stocks that have been moved to discretionary like Tesla and Amazon, it's 45% plus. Those companies have higher profit margins, more free cash flow. So I think the long-term trend is higher, and that's not even we are not even talking about, it's much cheaper to access the markets today. There's these automatic buys each month with index funds, 401ks. So yeah. I think the question is, okay, what level is it? And on a short-term basis, the market is more about sentiment, demand, and supply. Mm-hmm. And that's why it's hard to say, hey, this is what the valuation should stay at on a short-term basis. I think right now, we are likely to see some more investors squeezed in as you make new highs in the market.
And so as we're eyeing down a new record opening high for the S&P 500 just moments from now. How should the investor mindset really be positioning their portfolio around the rest of the second half of the year if we are to hold on to these new record high levels, especially considering what we had heard from many conversations is that we should be anticipating a lot of chop over the summer months here?
Well, and you may. I mean, historically, actually, July is actually a pretty good month, and historically, August, September tends to be a little bit more challenging. But I want to make big changes based on that. I think the big picture, though, too, we talked about the chop so far. The big picture, in my view, is we've been trading sideways for about 7 months. If you put a piece of paper and kind of over your charts and don't look at that big move down, I know it was scary, but the big picture is 7 months of chop. And for the technology sector, which just broke out, it's been basically in a trading range since last July. Yeah. So I still think the bias is still high. I think you still want to position for that. We're still focused more on some of these growth areas. We think the dominant theme of this bull market continues to be AI and tech, and that was the first sector to make new highs.
Are 7 stocks in the Mag 7 still the growth areas, or are there other more attractive opportunities that investors should be kind of indexing or over-indexing towards right now and taking profits where they can in some of those Mag 7 names?
Yeah, I think when you look at the Mag 7, you even see within there's differences of performance. I would just say more broadly, I think that the tech sector as a whole looks relatively strong. Semiconductors are also still below all-time highs. I think semiconductors will likely continue to do well as we see that demand for chips continue. But we also like, industrials, which, it's interesting. That's an indirect AI play because of all the power generation, the cooling systems that need because of all the heat that's generated as well. So we like that area as well. And communication services, which is also an AI play. Also, one other area I say, we've been Team USA for several years. We still like the USA the best, but I would say on the margin, we have increased our international exposure as well.
Where internationally?
More broad-based developed international. Think of Europe, think about Japan. I mean, the one thing is that those markets have outperformed this year, but when you kind of go back to when they peaked in 2007, they've lagged the U.S. market by roughly the S&P is up about 290%. Yeah. The EFI index, a proxy for those developed markets, up 10. We've had a multi-decade breakout, and it's also a hedge against the U.S. dollar as well.
Is part of that thesis also the anticipation that you're going to see trade deals come through in some of those developed markets?
Yeah, I think it's part of that. I think it's been underloved. I think just kind of some rebalancing on the margin is a positive. There's also stimulus measures, and also while the Fed is still kind of on this wait-and-see mode, the ECB, the central bank there, has been cutting rates as well. So again, we still prefer the U.S., but I say on the margin because there's still a wide range of scenarios, and also with the currency side. The currency is a big part of the international returns for U.S.-based investors. So I think it just provides a bit of a hedge as well.
We're just minutes away from the opening bell. We got to leave the conversation there for now. Keith, stick around. We've got a little bit more to discuss here. Coming up on Yahoo Finance, it's the Opening Bid, our brand new show. Opening Bid coming up next. Brian, we're going to be watching closely. What do you got on deck?
Well, I think Keith Lerner is sticking by, so I'm looking forward to disagreeing with everything he says on the bull market. Always enjoy talking to Keith and looking for any bearish calls he might have. But also going to dive into Nike that quarter. I think Julie mentioned it on the show, Brad. Wasn't a good quarter from Nike. The market seems too enthusiastic about it, in my humble opinion. And last but not least, we're going to stay on the consumer theme ahead of July 4th, talking to McCormick's CEO. Big food stocks not doing well this year. McCormick stock got embraced this week when it came out and beat earnings estimates. We'll talk to CEO Brendan Foley.
All right, that does it for Morning Brief, everyone. Opening Bid is coming up next, and the opening bell. Stick around.